everybody. Thanks so much for joining us today. My name's Hannah Mollison. I am the Sales Director here at Workwell Outsourcing, and I'm really pleased to be presenting this podcast where we will be debunking recruitment finance. I'm joined today by Marcus Carolan from Lloyds, and we basically just want to have a discussion around the myths around recruitment finance, what recruitment finance means to agencies, what it enables agencies to do, and kind of put things into layman's terms for recruitment businesses, because it can be a complete minefield with banking jargon and all of the different things that come with recruitment finance. This webinar is part of our educational series from the Workwell Outsourcing Academy. So we create content specifically for recruitment businesses to support their growth, provide value, and provide industry insights. And all of our webinars are available on our YouTube or Spotify, depending how you want to access them. So if you want to catch up on any previous recordings, you can find them all there. Just to give you a little bit of information about the Workwell Group, we are the UK's biggest service provider for recruitment agencies. So from funding, tech to outsourcing to international EOR and UK umbrella, our goal is to essentially enable recruitment businesses to focus on their core business of recruitment, while we handle the key operational functions. So thanks so much for joining me today, Marcus. Really appreciate you taking the time.
Thank you.
Would you like just to give the audience a bit of background of yourself?
Yeah, absolutely. Thank you very much, first of all, Hannah, for inviting me on. It's been great to sort of chat to you in the lead up to this as well. So, much appreciated. So, yeah, as you said, my name's Marcus Carolan, working for Lloyds Bank, Invoice Finance. I've been with Lloyds for 23 years in total now,
Wow.
Something like that, and 14 of those years within Invoice Finance specifically. So, from a sort of territory perspective, sort of cover London and surrounding areas, dealing with bank relationship managers that specialise within the recruitment space as well. So we have portfolios of clients there that operate specifically within recruitment, but also deal with introducers of business, such as yourselves, where we're looking to support clients, on a sort of a collaborative basis. So my sort of niche is recruitment. I specialise within the temporary recruitment industry for finance. Not to say it's just within recruitment, so also helping within other sectors as well. But recruitment's kind of my passion, really, and where my network has been built up. So really happy to join you today, and hopefully we can add a bit of value.
Yeah, great. So yeah, obviously you mentioned that you work with providers like ourselves. So here at Workwell, we have a panel of banks that we work closely with, and Lloyds is on that panel. Obviously, Workwell offer funding to recruitment businesses, and the service that we offer is something called 100% funding, which slightly differs to the finance that you offer. Isn't that right, Marcus?
Yeah, absolutely. So what we sort of found with the 100% funding option, as you sort of mentioned, is it tends to work very well for recruitment agencies who are sort of starting out on their journey.
Yeah.
So often ones where, really good consultants have decided they want to sort of go alone and set up on their own.
Make money for themselves.
Make money for themselves instead. So absolutely. And that's a very common scenario. So those types of businesses, they need funding, they need support. They're really good at the recruitment side of things. They're really good at selling and driving the sales of the business. But they do need a bit of extra support when it comes to the finances. So what they're looking for really is a trusted partner. And that's where the likes of Workwell come in, where you can start on day one by supporting and providing that full back office support. And 100% funding is part of that. And I'm sure you can explain that much better than I can.
Yeah. So I think what we find is we work with a mixture of startups and also established businesses when it comes to funding. But what we do tend to find, particularly with the startups, like you say, it would be, a high performing consultant that maybe decides that they want to go out on their own and earn money for themselves rather than earn money for someone else. And 9 times out of 10, they have a really great understanding of the sales aspect of recruiting. But when it comes to the back office part and the funding, to be fair, they just don't have the knowledge there. And that's, not a discredit to them. It's just because it's not what they've got the experience in. So they'll come to the likes of ourselves, and the beauty of our 100% funding model is that not only will we set up their business, we will payroll their workers so they don't have that administrative burden, because, you know, depending on the size of their contract book, if they're paying their workers themselves and going through that manual process, that could take them 2 days a week, which is 2 days a week taking them away from focusing on revenue generating activity.
Yeah.
So yeah, we not only fund them, we manage the back office for them. So we take away that, essentially that burden from them so that they can focus on what they're good at. The other thing that is very appealing is that we will pay the agency their margin on a weekly basis. So they have that profit straight back into their business. They can invest that back into their business, or they can go and spend it if they want. And it's all white labeled up to their business. So we also own the credit control piece. So what that means is that we will essentially own the debt, and we will chase the debt essentially, and make sure that the money is all recuperated. And they don't have to worry about doing that either, because again, it's another administrative task that they would have to do if they didn't.
Yeah, and that's a really important point, isn't it? Because that's such a time stealer for them as well, where they're having to chase the debt as well as trying to drive the sales and bring on more business. And also sometimes when the owner of the business, or the consultant who's now, you know, starting his own company, he's got really good relationships, or she's got really good relationships with their customer base, and sometimes the customers may even take advantage of that relationship, you know. So where you've got a third party involved in chasing the debt and making those kind of difficult phone calls sometimes to chase the debt, it can break the barrier between that kind of, you know, wonderful relationship that you know, the consultant has with the end customer, but having that third party can make a big difference, I'd assume.
So we play bad cop, they play good cop.
Exactly right.
Essentially. But yeah, like I said, so we'll process and calculate payment for all of their temporary workers. We can also fund perms as well if necessary. And then they get their margin weekly. We also send them a report every week where it's basically a financial report that tells them what they've billed, what they've sold, the VAT summary, if we have had to withhold any margin, why that would be. I mean, normally we have those conversations prior to that happening anyway, but obviously it'd be detailed in the report as well. We do also retain the VAT, and we pay it to them every quarter so that they can then make that payment to HMRC so that they don't overspend, and then they haven't got the money to pay their VAT. So it's a all-encompassing service, and we really try and kind of handhold and nurture agencies as they grow, because we don't just see ourselves as a funder, we see ourselves as a partner throughout that recruitment business's journey. But there does reach a point where the service we offer is no longer suitable for these agencies. They essentially get to a level of maturity, and it might not necessarily be the best option for them. And it's something that we monitor with our agencies. But then that's kind of when we have conversations with the likes of yourself, Marcus, and look at putting them on a finance facility with a bigger banking facility offer, want of a better word.
Yeah, absolutely. Is there a sort of a turnover sweet spot that you would say that you know you kind of tend to find your clients get to, where it's now the right time for that kind of a conversation? I appreciate every client has their own needs and it will differ, but is there typically
it does differ depending on their needs, but around kind of 3.5 million turnover really is when, because so the way our fee is structured as well is it's a percentage of the gross turnover. So on a weekly basis, the percentage of that gross turnover is where we would retain our fee from, and then obviously the rest the agency gets as their margin to do what they want with. So our kind of process is with say yourselves is we would then speak to the agency and say, look, this might not be the best option for you anymore. You've essentially kind of outgrown this service. But what, as you kind of previously mentioned before, Marcus, what we will do is introduce them with the bank, to a bank, and we'll help them arrange that facility. And the beauty of it is we will retain their back office. So nothing
Mm,
needs to change as far as they're concerned, and nothing needs to change as far as their clients are concerned and as far as their workers are concerned. So we will manage it all from a back office perspective, and it's a seamless transition for them.
yeah.
But I think what would be good to know from yourself is how does your service differ to what we offer, and how would that work for the agency?
Yeah, it's a really good point, and I think you've summarised it perfectly, because you've got that relationship already built in with your clients, and so you're naturally getting to the point where actually it's best advice then, isn't it, to say to the client, listen, you've reached a point where actually we might even be a bit expensive for you now, because you've got to a
Yeah.
point where you should be thinking differently, and you don't
Mm.
need that full, sort of 100% funding option, the full back office in the right sense. So actually now's the right time to talk about, let's look at alternative solutions and alternative ways of funding the business. So that's where,
Mm.
you and I and the team there would have sort of good conversations around, let's see what we can do to help the clients. And actually it's a nice natural sort of handover from the client to a more mainstream type provider like ourselves. So, we have, and I have many conversations with recruitment businesses where they've just reached that point where maybe it's just a bit too expensive. They don't need that level
Yeah.
of support. Let's have a conversation and look at options. And we'll provide options. That's what we're about, in terms of suggesting ways forward from the experience that we have in dealing with many, many recruitment businesses that have used a back office provider like yourself. And there's others in the
Yeah.
market where they've come to us to say, listen, I think this is a bit expensive, or perhaps the service isn't perhaps where it ought to be necessarily, not with yourselves, by the way. But it's about what is that next option, and invoice
Yeah.
discounting is that next option, really. So where we sort of come in is giving the client control of their own money effectively. So you mentioned earlier where you guys are managing the process and paying the recruitment agency the margin every week, so
Yeah.
they're getting the margin paid to them. That's their money to spend. They can do with that, how they please. But
Yeah.
invoice discounting works a little bit differently, where we're funding 90% typically on recruitment against the gross value of the invoice, and they're getting access to that full 90% typically within 24 hours. So, the client then has this 90% of the value of the invoice made available to them straight away for them to use how and when they please. So, we will create the availability and give them the access to the funds. What they do with it is entirely up to them. So suddenly
Yeah.
they've got this big access to their own cash flow and to their
Yeah.
own ledger. So they would typically use that money then obviously to pay the contractors for the wages. That's the important part. Mindfully then also keeping funds aside for HMRC as well. And that's where sort of trusted partners will sort of advise, make sure you do keep that aside, and that's coming down the road. But it's suddenly they're working differently because they're very much in control of their own cash. They're managing those relationships with their customers directly themselves as well. So from a process perspective, because we typically put in place confidential invoice discounting facilities. So, what that means effectively is we're leveraging cash against unpaid invoices, and their end customers don't know that Lloyds Bank Invoice Finance are
Yeah.
involved. As far as
Yeah.
they're concerned, they're dealing with XYZ Recruitment
Yeah.
Limited, and that's the relationship. So we're not going to be chasing for debt, and nor will you do in that sort of typical situation. But it enables the recruitment agency to have that, that relationship with the customers and just use us for funding. So we're just going to create availability. We're going to create funding against the invoices for them to use the money how they wish. So the good thing when it combines with the likes of yourselves, where you guys actually fully understand obviously the recruitment business, you understand how their needs are throughout the year. Could be seasonality in some of these businesses. Importantly, you really understand how our invoice finance facility works and how the systems work, because sometimes that can take a little bit of getting used to. But actually, Workwell, for example, know how our systems work. So actually, for the client, it's not such a big change for them. They're sort of moving on to a more mainstream facility, yes, but they're still getting the back office support from yourself. They can rely on yourself to manage that invoice finance facility, whilst still tapping into the expertise and experience of the client managers that run the invoice finance facility for Lloyds, so
and we really do try and manage it for them, so that because it's a big step for an agency, and sometimes we'll have these conversations with agencies, and they are maybe not necessarily comfortable with the transition initially, and it's obviously us explaining what that's going to look like, what we will manage in the process for them, and then what's going to look like for them when they're safe financed by yourselves instead of us.
Yeah.
And Yeah, I do think it is. Sometimes it can be a bit daunting for them because, like you say, they're essentially in charge of their own finance at that
Yeah.
point. Obviously, with the likes of ourselves supporting them, and like I say, we will continue to manage kind of as much or as little as they would like us to behind the
Mm,
scenes,
mm.
which hopefully gives them that comfort that the day-to-day running of their business won't actually change, but
Yeah.
ultimately it's a better solution for them at that point in their growth.
Yeah. Yeah, absolutely. 100% agree. They can focus on that growth. And that's the whole purpose of having a funding solution in the background as well. These are businesses that are high growth, that, recruiters are very, mindful of growing the book, looking at other options, diversifying into other territories. Suddenly
Yeah,
there's opportunities in
yeah,
IT recruitment in Europe, in Germany, obviously Europe, in Germany, Europe, and the US, for example.
yeah,
They're looking at funding options for that. So they would come to us and say, look, can we look at funding our customers in the US, for example? Yes, we can look at currency lines that can be set up. We can look at banking solutions as well, if that's something that the client needs, because they don't have to bank with Lloyds in order to use our invoice finance facilities. However, it can work really well where we are supporting on the banking. They've got a dedicated recruitment specialist bank relationship manager that manages
yeah,
the banking and all the access to the different solutions that are available through a big bank like Lloyds, as you'd expect. You've got the invoice finance client manager that runs the invoice finance facility. You've got the guys and girls at Workwell that manage the back office. So you've got this kind of trusted sort of partnership, really, where everyone's trying to support this business to help it grow. And that's the whole idea of invoice finance specifically, where what we might put in place today, when I look at and speak to a client, we will always ask them what their next 12-month projections look like, because
yeah,
we
yeah,
want to put in place a facility that is going to enable them to grow. The worst
yeah,
case scenario would be if we put in a facility size and in 2 months' time they're knocking on the door, needing an increase in it because we haven't calculated correctly the growth of the business. So we always add in a bit of wriggle room so they can grow into the facility. And
yeah,
the whole point of invoice finance is that it will grow as the business grows and the demands are there. So it's a really good conversation and really good problem to have, where a client comes to us saying, listen, got an opportunity to take on a big contract in Germany or another contract in the UK, for example, but we haven't got the funds to do it. We need to increase our facility. That can be done on a local basis and would enable them to take on those contracts to help the business grow. So where we're seeing recruitment agencies coming to us on a million turnover, 3 million, 4 million, whatever it might be, in 6 months, a year, 2 years time, suddenly they're rapidly growing their business because they've got that cash flow to be able to do it. And
yeah.
ultimately, a business without suitable cash flow is doomed, really. So that's where we all sort of pull together to try and support the business, ultimately.
Yeah, because I guess some agencies might think when they get to a certain size, why would they not just self-fund? But it might be that, they have to walk away from a big contract in case they can't afford it.
Yeah, absolutely. And we see all sorts of different size businesses. We're starting with these, the new start type entities where they need that back office support and our support. We're working well together. My sort of remit is typically up to about 25 million turnover, and then we have a mid-markets team that go from 25 to sort of 100 million turnover in terms of the opportunity there. So the client generally comes on board knowing they've got a really long journey of support as they can continue with us. So that's quite reassuring for them. And there's some amazing success stories out there. I mean, recruitment is tricky at the minute, I think is a word. There's a
Yeah.
lot of industries where
Yeah.
sectors that are struggling, but there's some really good success stories as well. And we've got clients, we talked about the sweet spot earlier. Typically I would say about £1 million turnover is when clients come to us, having used a back office provider, saying, starting to get a bit expensive now. Let's have a look at the overall options, and then we can come on board. But there's plenty of clients out there that we've taken on board where in the 20+ million turnover that are using a back office provider just because they've always done it and they've never really
Yeah.
questioned it. They've never really looked at other options, and suddenly we're more than halving their overall fee sort of cost
Yeah.
structure, and it's a bit of an eye opener. And actually having a suitable solution in place with suitable back office can make a massive difference for them. So
Yeah. I mean that we talk about back office and outsourcing. I mean, I could literally do a whole another podcast on the varieties of how recruitment businesses outsource and use a back office provider. But because there's obviously offshore and onshore, and again, these large enterprise agencies, they get to a certain point where a back office provider in the UK is no longer the most price effective option for them, and the agencies are starting to look at overseas outsourced providers. It's becoming so much more popular at the moment as well. All the big agencies seem to be doing it. Is what we're finding. But like I said, I could do a whole nother podcast on that, so I won't go into that. But again, from our perspective as well, again, when we see an agency reaching a certain point, we provide offshore back office as well. It's UK managed, so again, we will carry on kind of nurturing them through their journey. And if our UK back office service is no longer suitable for them, or maybe not the most price effective service line for them, we'll then again have those discussions to potentially move them to an offshore back office service. So yeah, there's loads of different ways that we try and help agencies as they grow. But back to finance.
Yeah.
So from an invoice finance facility perspective, what security is required from your side?
Yeah, it's a good question. It's a common question that we have as well. So I suppose the beauty of invoice finance versus a more traditional type of funding, option. So either clients have come out of self-funding, if they come to a bank and look at funding options, a bank would normally look at invoice finance as a better funding option for a recruitment business than, let's say, a traditional overdraft facility, because a bank would always need some sort of tangible security, or typically some tangible security to support an overdraft, which generally means a charge on somebody's house or some other supporting security coupled with a personal guarantee from the directors. So invoice finance is about the book debt. We're interested in who the client deals with, who the end customers and who the debtors, what they're doing for them and how they're doing it effectively. And where you've got temporary recruitment, it's probably the easiest sort of form of debt for us to fund, because it's undisputed signed timesheet work that we can fund quite happily to sort of 90%. So the security that we take is first of all an all assets debenture that's registered on the business. So essentially what that means is, that's our route to security. So if we're lending to the recruitment agency and we've got our all assets debenture registered on the business, if the recruitment agency fails for whatever reason, under that debenture we can then go to the customers for repayment of the invoices. So we own the book debt of the business effectively. And coupled with that, we may ask the directors to provide a personal guarantee each as well. So that's dependent on the strength of the business. Maybe there's some quirks within the facility that we're looking at the time, that we need to sort of be mindful of. Perhaps the business isn't particularly profitable at the moment for whatever reason, but we're happy with the journey that they're going on. So that would determine the level of personal guarantee as well. But our personal guarantees aren't charged on tangible security, so there's no supporting charges on directors' properties, which sometimes they may think is the risk, of providing a PG. It gives us comfort knowing that the directors are supportive of their own business, and where we're lending hundreds of thousands of pounds and millions of pounds sometimes on invoice finance facilities, asking the directors to provide a personal guarantee or a fraud warranty or performance warranty without going into too much detail. It just shows the lender that the directors are supportive. If it does go horribly wrong, and touch wood it doesn't, and we're miserable at the bank when we have to think that way, but it's just the way it is, that we've got some sort of support from the directors if needs be, that they would help us recover funds or speak to the customers if that was needed. But 9 times out of 10 what we're looking at is the strength of the debtors, and the actual debenture is our route to security.
Yeah, we're exactly the same with the personal guarantee and debenture as well, from the 100% funding perspective as well. Do you get much pushback from your customers on that at all when you sort of talk about personal guarantees? I mean, I don't necessarily find it, but sometimes people aren't comfortable with it, but honestly, not a lot at all. It doesn't. I think, to be honest, it's just the nature of being funded or financed. So I think it's expected, probably.
I agree. I think so. I think you're right. I think people just understand that actually if they're utilising a facility size of that amount, and then we explain to them, actually what does the PG really mean? When would it actually be taken into consideration? Then they're more than happy to provide it. There are other options we can talk about with clients if needs be. But depending on each case on its own merit, really, that's what we look at.
And I think, like you say, it's just about the agencies or the director's understanding of what it actually means, and having that conversation, because they might hear the word and think, oh, goodness, you know, why
Yeah.
would you need the personal guarantee? Or, you know, so it's just being able to have that conversation and get that understanding, which again, I think, especially for the startup with us, there's a lot of kind of like an educational piece to a certain extent that we will have with startups to kind of get them comfortable with how this funding process works. So from the 100% funding perspective, like I said previously, our fee structure is a percentage fee of the gross turnover. What's the fee structure with a facility of yourselves?
Yeah, so typically there's two main fees really. So, you know, we still charge a service fee, you know, of the gross turnover of the business in a similar way. So where you're charging a percentage of the turnover, a percentage of the invoice value, we would do that in a very similar way, but it would tend to be a lot cheaper, only because the level of service that we're providing is a lot less, you know. So you're building in the cost of the full back office support and everything within your percentage. Ours is different. We're funding the invoices, so our service fee is a lot cheaper, but still just a percentage of the turnover. And then there's a discount margin over base, and effectively that's the cost of funds. So you know, when a client is given the 90% against the book debt value, if they're not borrowing from that facility, they're not going to get charged the discount fee on that money, because it's essentially not being borrowed. When they start to use the money, and we hope they do, that's the whole purpose of the facility, they're charged interest on the amount that they're borrowing and for the time that they're borrowing as well. And that's calculated as a percentage over base rate per annum, but calculated on a daily basis. So it's actually quite a cheap form of borrowing. You know, if you imagine it in the same sort of way as an overdraft facility, if you go overdrawn, you're charged interest on the amount that you're overdrawn until you go back into credit again. So quite similar in that respect. And it's about control. So the client has real control of their own money. You know, they would only draw down on the facility if they need to borrow the money to pay their contractors and they need access to cash. And again, within recruitment, they will always need that, you know, on hand to do so. But they are in control of that money themselves, you know. So they're the two main fees. We have a very open, transparent pricing structure within the facility. So we always have a kind of a full spread of potential costs within invoice finance. And I say potential because it really depends on each individual circumstance. And I think that's, you know, we talked about myths of invoice finance. One of those is it's high cost. You know, there's lots of hidden charges, things like that. It's not really the case. You know, we have a very transparent sort of cost structure, and some of those costs are only apparent if you're perhaps not doing something correctly within the facility or other scenarios. But we always talk to clients about those, look at the overall cost structure, look at how perhaps we compare to other lenders. You know, so sometimes they may say, look,
in the marketplace.
I've gone to another sort of 3 banks and they're charging this, but you're pricing slightly different on here. Or, you know, one lender might be charging a fixed monthly fee as a service fee. Fine, we can do the same sort of thing, you know, so we can be very adaptive in that circumstance and just understand what is important to the client and how they want to structure that. There is a fee obviously for the facility, of course, but you know, it generally is cheaper than a full back office support, but for a reason, because of the lack of full credit control and so forth that you guys will be undertaking. So but we also have those conversations with the clients at the very beginning, make sure they're happy with everything before we then delve into a full application to get a facility supported for them.
And that's the exact reason why we work with banks like yourselves, because it is essentially a cheaper option for them, and they would pay for the back office separately then, and it's more price effective, which it's only a good thing for the agency.
And sometimes it's, you know, this isn't doing anyone out of any business, but sometimes it's the right thing where they're actually of a really decent size, where the cost savings that we can make enables them to then bring in their own in-house accounting function and support, you know, and that may be the right thing for the business at the time. You know, suddenly their cost savings are so big that actually, if I employ someone to come in and do my credit control and, you know, have an accountant or a bookkeeper that can manage the invoice finance facility for us, that could be a cheap option for them as well. But I think normally when we talk to the likes of yourselves, that kind of transition from, you know, back office through to that kind of mutual type facility is well positioned, and clients feel comfortable with that because they don't want to let go of Workwell, for example, but they want the cost benefits of having a mainstream provider, you know, supporting their business. So it can work very well.
It's definitely the comfort element, isn't it? And I guess as well, you know, if they've grown with us, they've got to a certain point, successfully with us, and have used us as a partner to get to that point, it gives them comfort that they know that they still got that support there.
Yeah.
And also, if they do want to employ people, 9 times out of 10, it's expensive to have like a full-time credit controller, or to have a full-time FD, whatever it might be. Those are expensive resources to have, and expensive overhead. So again, it might be where if they're at a point where they want to move to their own facility, however, they don't want the cost implications of actually having those heads in the business.
Exactly. Yeah, absolutely.
Yeah. That's our time pretty much spent.
Excellent.
That's gone very quick, half an hour already.
We could carry on talking. There's so much to chat about it, but you don't want to bore the listeners too much. But so thank you.
No, thanks so much for joining me today, Marcus, and thanks for pursuing this, even though we did have some technical difficulties before we jumped on.
Google to the rescue, right?
yeah, Google and AI. Thanks so much, everybody, for joining us today. I hope that this has been useful and educational. I will be back in the next couple of weeks with my next podcast, and look forward to everyone joining me then. Thanks again, Marcus.
Thank you.